As inflation continues to increase, commodity stocks look better and better as investments. But of course you want to get in before it's too late. So in this video, I'm going to be looking at Sprott Inc. and seeing are they under or overvalued and should we buy them. Hey, my name is Tucker Kraus, I'm a 14-year-old investor, and in today's video I'm going to be doing a quick stock analysis of Sprott to determine if they are a buy. I'm going to first do a quick introduction into their stock, and then the company, and then dive a little bit more in depth into their financials. So let's quickly hop into their financials.
Sprott currently trades with the ticker symbol SII on the New York Stock Exchange as well as the Toronto Stock Exchange. I'm focusing on the New York Stock Exchange due to the fact that as of 2020, their financials are all listed in US dollars. They're currently trading at $46.06 per share with a market cap of $1.15 billion and a PE ratio of 41.19 and a dividend yield of 2.18%. So on the surface, it does look like, they could be a little bit overvalued with that 40 PE multiple, but we need to, of course, look into it a little bit further.
Onto a quick company introduction. Sprott is of course best known for their precious metals trusts and that sort of thing.
Of course, Sprott is best known for their physical bullion trust, whether that is PSLV or SPPP or whatever it's going to be. They also offer gold mining ETFs as well as a variety of different types of precious metal investments.
Now, the main thing that definitely caught my eye is the recent news that they entered a deal to acquire Uranium Participation Corp so that they could create a uranium trust alongside their physical precious metals trusts. Sprott's main growth aspect is, of course, if commodity and precious metal investing booms, then a whole lot of people are going to look to Sprott to invest their money with things like PSLV. And so if money floods into a bunch of their trusts, their assets under management will skyrocket, and so the small fees that they charge will be producing a lot more cash flow to Sprott. And of course, if commodity investing surges, then the price of commodities will surge even more so than they are with just inflation and whatnot. And so that'll mean the worth of their assets under management will not only grow from people investing into it, but also their worth just on its own will grow, because if, say, gold price doubles, then their gold that they have stored is going to double in value. Though, because they're generally going to be buying these precious metals and whatnot, and not necessarily producing them like a mine or selling them like a royalty company, that does mean they won't benefit as greatly from the price surging, but of course the price surge and the investing surge come alongside each other, so those both kind of add together to being great for Sprott and any other precious metal or commodity company.
To quickly clarify that, essentially their income statement and cash flow statement would be boosted substantially by precious metals investing, and then their balance sheet would be boosted substantially by precious metal price increases.
Now, before we continue, make sure to smash that like button. Now, let's continue into the rest of the video.
In May of 2020, Sprott had a 10-to-1 share consolidation, and so because of that, I'm not going to be looking at per share amounts, and that includes the start of the filled town mode analysis as well as EPS history, since, of course, a 10-to-1 consolidation just makes it not fair. But we can see here return on invested capital, which basically shows, okay, is the management team doing a good job at growing the company? We would want this to be over 10%, but 6.63% isn't necessarily terrible, so not good, not bad, just it's okay, it's mediocre. Now, return on equity, this shows is the management increasing the value of the shareholders, and we can see here they are doing fairly alright with this, 9.27%. We would of course want over 10%, so here just fine, not amazing, but not necessarily mediocre like the return on invested capital. Now here though is really good. This is the debt to earnings ratio. We can see it would take them just a little over half a year to pay off all of their long-term debt if they lumped all of their net income into it. So of course that's really good, and depending on your opinion could make up for the fairly mediocre return on invested capital. But let's quickly hop into their revenue and net income histories. Now here is their revenue versus gold price, and we can see that their revenue, just ignoring gold price for now, is definitely all over the place, and then including gold price isn't necessarily following it that much either. We can see gold price increases, revenue decreased. Right here, gold price decreased, revenue increased, though very slightly in both these cases. Doing the same thing with silver, we can see it doesn't really follow that pattern either. And the only thing that's really notable about the revenue though is the substantial jump we saw from 2019 to 2020, of course with the large rally that things like gold had through 2020. Now, net income versus gold price, we can see doesn't really follow the gold price either, and that holds true for silver. But we can also see in general, the net income, like the revenue, is certainly all over the place. And we can see 2013, 2015 were substantially in the red, even though their revenue wasn't substantially lower. In fact, 2019 had lower revenue than both those years, yet came out positive. But again, the main notable thing here, I would say, is that there was quite the jump from 2019 through to 2020. Now on to a quick asset-based model. This is as of their Q1 report, and so we can see that their total assets minus total liabilities divided by shares outstanding gives us a floor value of $11.63, which is of course substantially lower than the $46.06 they are trading for at this moment. But of course, floor value is typically going to be lower than the company's current value. That's the case for almost every company I look at. So let's see if their free cash flow will look good instead. So we can see here that their base discounted free cash flow is substantially lower than what they're trading at right now. With a margin of safety, you'd only want to buy in at, say, $5. And with this boosted discounted free cash flow, you probably only want to buy in at, say, $10. And again, that's still a far cry from where it's trading at. And even if you were to buy without a margin of safety, again, still a massive difference. Now, the difference between these two is, I have these two notes right here, of course, is that from 2017 through 2020, the revenue and net income and free cash flow compounded annual growth rates were frankly awful, and the highest one there was revenue at 0.8%, because we can see here that it was lower 2017 through to compared to 2020 for net income, and revenue right here, it's barely an increase, and then free cash flow was also negative, like was net income comparing 2017 through 2020. And so because they were only getting 0.8% revenue growth, of course that made it look not good, to put it mildly. But because we also saw that massive jump in 2020, it's very possible they continue to substantially grow. I'm just assuming, let's say, a 25% revenue growth is quite fair. So in that case, yes, they would be worth a good bit more, but still definitely quite overvalued. And that's clearly shown since, hey, they're about halfway over this discounted free cash flow, or about double, sorry, and they have a PE ratio of 40, whereas something about 20 is much more acceptable. So in both cases, about a double of what's a fair value compared to their current value. But let's quickly hop into the outro and my thoughts.
Now, me personally, after looking at those discounted free cash flow numbers, I'm probably going to avoid them. Though, that's not to say anything bad about, say, their trusts or whatnot. I'm sure those are all great ideas, especially for someone like me. Since I'm 14, probably not a good idea to go buy silver bullion, probably great to invest in, again, PSLV as an example. Though, of course, if you think, say, their revenue will continue to double each year, if it's going to go up 50% each year, then it's very likely that at this point they're undervalued. I just wanted to be more conservative. But if you think that, then it's very possible if you then want to punch in the numbers yourself, okay, then it looks like they actually are undervalued. You have different ways of looking at this depending on what you think their growth probability is and how much they're going to be growing by. And there's a whole bunch of nuance there, of course. Not enough to cover in just one short little YouTube video. So if you enjoyed, make sure to smash that like button, and I will see you next time.